Consolidations, Comprehensive Problem, Part 4. This is Ken Boyd, the owner of St. Louis Test Preparation. And where I had left off, if I go over to the equity section of the balance sheet here, we had covered consolidated retained earnings, starting at the top here on the last video and working our way down. We had then gone over to consolidated net income, started to explain that we talked about the subs net income for 2013 first. We make adjustments for upstream transactions in both opening and closing inventory, the fact that the sub had an unrealized gain on sale to the parent that needs to be eliminated. Amortization of fair value differentials is eliminated. We come up with the adjusted subsidiaries net income, and then we divided that out to show you the amount of the adjusted net income change for the sub that went to the non-controlling interest, which is 20%. I need to talk about goodwill impairment because goodwill impairment reduces this net income calculation. So let's go over to that. This is something I didn't cover on the videos so far. So you'll see on the General Information tab, here's goodwill impairment for the end of 2013. And there's a note that there's no evidence of goodwill prior to the end of 2012. So the first issue is, well, how do we measure the value of the company at the end of 2013? We take the shares outstanding and we multiply it by a number we're given the market value, and we come up with 5.2 million. The fair market value of the net of identifiable assets as of 12/31/2013 is $4,550,000. So our goodwill, the amount that we paid, the amount of the value in blue above the fair market value of the net identifiable assets in green is goodwill by definition. Now, the goodwill we had at acquisition was $720,000. If I go back up to the top here, you remember on the first part one of this series that goodwill was calculated to be $718,000. There was a small error in the problem, so I said $720 as goodwill at purchase. And that's the goodwill number that we have in this impairment analysis right here. So the issue is that goodwill has become impaired or permanently declined by $70,000. $57,400 of that impairment goes toward the parent, and the remaining 20% goes to the non-controlling interest. So jumping back to consolidated net income, we are subtracting the parent's portion of the goodwill impairment in the current period being 2013. We also have unrealized profits on upstream transactions, that is, transactions from sub to parent. Upstream transaction from sub to parent, I'm going to change that. So we had a couple things going. We had a profit on opening inventory of $21,000. Since that opening inventory is assumed to be sold to a third party, to the outside world, if you will, that profit is added in because we can count that as profit in consolidation because now somebody outside the two companies has bought the merchandise and we can record that profit, and that's okay in a consolidation. Closing inventory, however, that unrealized gain of $12,000 is excluded because if the product is still in ending inventory, by definition, the profit hasn't been recognized. We haven't sold it to a third party in the outside world. So where we end up with, where we throw in here is the parent's net income, which we figured out over here on the retained earnings tab. Parent's net income. And we also had dividends declared by the sub, of which 80% of those declared dividends are going to be included in Acme, the parent's income, to the tune of $72,000. So what we get in the summation is we get consolidated income attributable to the parent. And just by way of review, because it's getting a little tricky to follow, we start off with the sub's net income, adjustment to the sub, adjustment for fair value. We break out the portion that goes to the non-controlling interest. That's a subtraction. We subtract the goodwill impairment for the period 2013. We adjust for upstream transactions. Opening inventory, we count an inventory. Items in profit that's in closing inventory, we subtract to exclude it. We add in the parent's net income, and we subtract the parent's portion of the XYZ's dividend, so we don't count that dividend income as income to the parent because we want to exclude that for purposes of consolidation. So all that being said is we get this big summation that is net income attributable to the parent. And then finally on this sheet, we do a little reconciliation of consolidated net income that goes to the non-controlling interest. Remember that the non-controlling interest has 20% of the total. So 20% times that non-controlling interest, if I go back up to the top, there's the sub's net income. And now we're saying that the non-controlling interest gets 20% of that number right there. We then subtract out the parent's share of goodwill impairment loss. If I was to go back to the general info tab, I see that goodwill impairment attributable to the non-controlling interest is $12,600. That gets subtracted. So there's net income attributable to the non-controlling interest. And I can add that up and get consolidated net income. In blue, net income attributable to parent. In green, attributable to the non-controlling interest. We move on to now consolidating the balance sheet, which we won't get to completely on this video. But I have Acme and XYZ's beginning balance sheet balances here. And then I have elimination entries in the middle. And we need to talk about how we get these elimination entries. First of all, on accounts receivable, you'll see that there's a dividend that's removed from accounts receivable because Acme shouldn't be owed that dividend in consolidation. And the dividend payable also gets removed in consolidation. And if I go down to footnote 2, I see that that's Acme's share, the parent, of the sub's dividend payable. 80% of XYZ's dividend payable is eliminated in the amount of $32,000. Note 3, the inventory item, we're subtracting out $33,600. That's the unrealized profit in ending inventory, that closing inventory that gets eliminated. If I go back over here to unrealized gains and losses, and I go down to ending inventory, there's the $33,600. That's what's getting eliminated in the balance sheet right here and getting eliminated right here. Note 4 relates to the equipment, $108,000, which is the sum of the intercompany gain on sale, which was $44,000 less $2,000 in amortization. Fair market value differential of the equipment right here. That's over on the general info tab. It totals $108,000. So on note 3, $108,000 is our amortization. One more on this video, which will be building note 5, $95,200. That's the fair market value differential for the building as of 12/31/2013, $95,200. And just as a reminder of where these numbers are coming from, If I go to that fair market differential detail, building, there's the 95,200. Equipment, there's the 66,000. So that's how that's running along. What we'll do on the next video is continue on the balance sheet and pick up on note 6. Thanks very much for watching. We'll see you next time. Before I forget, remember at St. Louis Test Prep we have our excuse me, accounting video textbooks. There are 2 of them out there right now. Accounting for Investment, Advanced Accounting, which will include this discussion. Here's the length of the video and the cost. You get the video themselves, you get the Excel templates used to create the video as a practice exam in Excel, and the answers to the practice exam are also in a video format. Thanks very much for watching. We'll see you next time.